Today, our guest is Marcus Blanchard at Focal Point Planning. Marcus, thanks for letting me pick your brain. By means of background, Marcus and I have kind of been going back and forth here on LinkedIn for quite some time, and we've had countless phone calls, and he's really just a wealth of knowledge. So I did want to bring him on here to share a little bit about his business. So Marcus, I'll let you go ahead and introduce yourself, and if you want to go ahead and give maybe a brief summary and talk about what you do and what your expertise is in.
Sure. Yeah, absolutely. Thanks again for having me on, Paul. I really appreciate it. I'm Marcus Blanchard. I am a financial advisor and the owner of Focal Point Financial Planning. Okay. Really my specialty there is to put it in layman's terms, I help you not get killed in taxes when you sell your business or property, and also when you're getting ready for retirement. So those are typically two big life-changing events. Oftentimes they happen at the same time, but not all the time. And the cost of getting it wrong is quite high.
Yeah,
so that's me. That's what I like to nerd out on and help people out with.
Okay, cool. And I know in previous phone calls, we've actually talked a little bit about it, but we haven't gone too far in depth. So if you want to maybe catch some people who might be listening in on it, and I can kind of point it in the right direction by saying, where were you at in August of 2009 and maybe a little bit further of how that sort of impacted maybe your journey of becoming a financial advisor.
Sure. Yeah. So I think, everybody can think back to their first memory of money or their first experience with money. The one that really stood out to me was, like you said, back in August of 2009, I had just enlisted in the Marine Corps. I was going through boot camp down in sunny Southern California. And they had just given us like the government's 401k, like sign-up sheet, right? The TSP, for those who are familiar. And, I was 18 years old at the time, and I just remember thinking through it and just thinking to myself, I have no idea what any of this stuff means. Right. I don't know how much I should be investing. I don't know what to invest into. I don't know what account type I should choose. Just totally lost, and I looked around at the other 18-year-olds around me, and of course, no one else knew what they were doing either. And if you keep track of financial history at all, 2009 was started to come out of a very rough time period, and I made all the wrong decisions. Okay. So, knowing what I know now, looking back, it's, I wasn't investing enough. I was invested like a 70-year-old when I was 18. So I missed out on a lot of gains that I could have had, right? Luckily, there's the opportunity cost rather than an actual loss cost. But, I hated that feeling like I was guessing, because that's quite literally what I was doing as I was filling out this form of just check the box, just get it done. We're going to go on with our day. And as that's kind of what got me started, right? Got me interested in finances because I told myself, I don't want to be in that situation again. I don't want to feel like I am guessing when it comes to making, what felt like to me at the time, big decisions with my money. Okay. So I started to learn and grow. And that's actually, I'm one of the few people who can say that they actually used their degree in their everyday lives. So I did study this in college. I got a degree from Utah Valley University in personal financial planning. Okay. And as I learned that, I realized that people are in that same situation, but they're making these decisions with a lot greater sum of money, right? They have a life's accumulation of savings for a piece of property or a business that they've built over decades, and they don't know what to do.
Right.
So that's a terrible feeling. It's a terrible thing to hear of like, oh, I wish I had known that sooner. It's an even more terrible thing to have to say. So ultimately that's why I am here today. And specifically with my own firm is so that I can help people never have to say again, I wish I had known that sooner.
Gotcha. And would you kind of consider that maybe your why for, becoming a financial advisor and really maybe making a difference in your field and in other people's lives?
Yeah. Oh, absolutely. So again, it did start with selfish reasons of, hey, I want to know how this how all this stuff works for my own finances.
Yeah.
But then once I got a handle on that, I looked around and saw that everybody was walking in the dark as well, right? Just like my first experience. Nobody knew what they're doing. And if you have a light, then shine it, right? Help people find their way.
I agree. And I know that, right out the gate, you sort of, you decided that instead of joining maybe a more established firm, you were going to start out and you started your own firm. Do you want to maybe go a little bit into that and, talk about why you decided to do it that way?
Yeah. So I didn't start right out of the gate, started
Okay.
my own firm, just to clarify.
Sure.
I originally started at a large brokerage, firm.
Okay.
They're green. If
Nice.
anybody
Yeah,
put those
yeah.
two together. In college, it's a call center job. It paid the bills. It was a really good introductory step to kind of learn. Okay, I understand all these concepts, but where does the rubber actually meet the road, right? How do you open these accounts? How do you do this? How do you do that? And that was a good learning experience.
Okay.
But as I, learned and progressed in my own career, and in getting additional designations like the certified financial planner, it's a mile wide and an inch deep, but you learn a lot of things that, different business models don't necessarily cater to, right? And it's not right or wrong. It's just, that's the business that they've built. So I wanted to go a little bit deeper, right? I really wanted to look at taxes and how do we look at the big picture, right? The whole picture here. So I left. I went to a smaller firm here. I'm out of Utah for anybody that doesn't know. Went to a smaller firm here in Utah. I'm trying to find that. Long story short, I didn't. It wasn't a good fit, but again, still a very good learning experience. I picked up a lot of operational experience of just, again, how is the juice made, or whatever the saying is.
Yeah, no, I gotcha.
Which was valuable. And at that point I decided, you know what, I can either, take another chance on someone else,
Sure.
and hope I find a good fit, or I can take a chance on myself and build a firm exactly the way I want. Right.
Yeah.
So ultimately that's what led me here today, and starting Focal Point Financial Planning a little more than 2 years ago was, I want to do things my way. I want to provide high quality service, and I don't want to dilute that service by having hundreds and hundreds of households, because I know myself, and I know what I'm good at and what I don't enjoy, and I do not enjoy managing people.
Yeah.
Okay, so my vision for this firm is not to hire, hey, I'm going to build this big enterprise firm. We're going to bring in a bunch of advisors, like more of a high level business owner thing. I enjoy what I do. So to accomplish that vision, I also need to limit the number of households I work with. All right. So the vision right now, it can always change, but hey, I'm going to work with 50 households. I'm going to do really, really good work for them. We're going to go deep, and I'm going to know everything about their situation. And then, seats taken, there's only so many seats on the bus, and at some point you got to drive off. So
Definitely. And
that's, yeah.
Awesome. Yeah, no, and kind of touching on that as well. If someone's watching this and they're sort of, maybe they're at a call center or they're at a different job or maybe a larger firm, what would you maybe advise of them if they're considering starting their own firm? Or maybe you have some tips on a big hurdle or two that you had along the way? Because, there might be someone out there who's watching this and they're saying, well, hey, how did you do it? So what tips would you have for that person?
Save cash.
Save cash.
Yeah. Build up a cash runway, because most of the firms, you're going to have I was told, hey, have at least like a 2 to 3 year cash runway to cover expenses, because it's going to take about that long to kind of get back to where you were. So it's a lot of short-term pain for long-term payoff. So don't underestimate the cash burn that you'll probably have. And really most of the burn is just your personal expenses.
Sure.
But before you get to that point, just be honest with yourself and make a list of, what do I enjoy? What do I enjoy doing? What interests me? And what doesn't interest me?
Yeah.
So, for me, it was very much, I don't like being told what to do as much, or if I have an idea, I wanted to be nimble, right? I'd learn about, new strategies or new information, and I couldn't implement it because of company XYZ's business model, or we have too many clients and we just don't have time. So just play to your strengths, right? If you love talking to people and building networks and relationships, like, you can do that in a lot of different places. You don't have to go out on your own to do that, and have a very successful career. If you are not sales oriented, there's plenty of firms out there where they say, hey, we have so many clients, we just want you to service them.
Yeah.
Just help them out. You don't have to do any prospecting or any sales. Just help us help our clients.
Yeah.
So just realize, especially at the big brokerage firms, that is your world, is their kind of ecosystem that they've built. It's a big world outside of that. There's more tools, there's more software, there's more, you can niche down, you can say no to people, because everybody deserves expert advice. And I know that I'm not the expert for everybody, right? That's why I specifically say, hey, if you have a large capital gain and or you're getting ready to retire, I'm going to add a lot of value for you. But if you come to me and you have questions about college funding or your student loans or that stuff, I probably could help you, but there's tons of advisors out there where that's their specialty. Hey, you have questions on all your, stock options from your publicly traded tech company that you work with. Go work with somebody where that's all they do. They're going to spot things because this is all they look at all day long, and it's just going to be a lot better experience. So, kind of a long answer. Sorry, I got a little
No, that was great. That was honestly exactly what I was looking for. And I think you kind of mentioned something else I was going to ask you, because I know that you advocate for a deferred sales trust, and that's not the reason why I am having you on here today.
Yeah, it's a great tool.
But what are some of maybe the strategies that you employ for, some of the clients that you work with? And obviously, again, I know the deferred sales trust is one of them, but there's probably a lot of other ones that you do implement, and really it just depends on what your client needs. So what are maybe some of those clients, look like, and how do you help them?
Yeah. I mean, and you hit the nail on the head. Deferred sales trust is a great tool, but just like any strategy, it's not a fit for everybody. So if I had to just, I don't want to say dumb it down, but oversimplify it, tax strategy and tax planning is deferring income when you're in a high tax bracket and paying it or realizing it when you're in a low tax bracket. That's it. Okay. I don't want to make it sound like, oh, it's so easy, that's it. Well, there's a lot of different ways and instruments to accomplish that. It just depends on what you want to do, right? If you're a big real estate bug, 1031 exchange is probably going to be the first thing that you should look at, right? From there, there's 1031 exchanges, there's opportunity zones for capital gains. Again, it's just how do we match your income to what we're expecting those taxes to be? And looking into the future, a lot of that's guesswork. Okay, so a lot of it is how do we take the facts we know now and project that into the future, right? Are you a high earning commercial real estate agent that's earning high six figures, into the seven figures every year?
Yeah.
But when you take that step back, you only need to live on 250,000, that's a big opportunity. Let's defer as much as we can and then realize that income at lower tax rates. Another thing to think about is historical tax rates. If you look at that chart, it's humbling. The top historical tax bracket was up to 90% for several decades. It's not like it was just a little blip at time. So when you look at government spending and taxes and just that big macro view, what do you think is more likely, right? Not you specifically, but just think about into the future of, do you think that tax rates have the potential to go up, or do you think that the government's going to cut back on their spending? Which is more likely? Okay, and it's not mutually exclusive, hopefully, right? Hopefully some fiscal responsibility does come in. But we also don't want to be so cavalier as to say this is what's going to happen, because there's a million ways that they can slice that pie. Of what taxes do they raise, on whom, at what income level. But that's the stuff that we're wanting to look at, is what are you making now? What are you going to live on in the future? So some of the tools to do that, obviously deferred sales trust, opportunity zone funds, if it fits, right? If they like real estate and they have a long-term horizon.
Yeah.
Something as easy as just Roth conversions, right? If you have a lot of people that I come across, they're kind of sitting on a tax landmine and they don't even know it.
Yeah.
The problem is that landmine isn't going to go off until 20 years from now. And the problem is that we as humans don't care about future us. I think there are some studies that, we basically future you is no different than a stranger walking by you on a street, of just like the weight that we put on it. Yeah. I care about future you. Right? That's what my
Thanks,
job
Marcus.
is
I appreciate it.
to watch out for is several decades into the future. But if you've deferred everything and now you have this huge deferred payment that the government they want their cut, right? You don't actually own, like for your 401k, for example, or whatever. If you have $1 million, you don't actually have $1 million because you and the government are a partner in that growth. Yeah. So again, if we can find strategic years, or like in down markets, for example, where it makes sense to, hey, let's prepay some of that tax, let's shift it over intelligently into a Roth. That way you lock in tax-free growth. You have more flexibility, especially if it's a partner or their spouses. They get to file taxes as married filing jointly. If something were to happen to one of them and the other is left for several decades, it's called the widow's tax. They get bumped back into the single tax bracket, even though they're still probably living on roughly the same income. Yeah. So now their tax bracket is back up, and deferring the taxes for the last 30 years, now you're paying the same tax rate or higher, and that doesn't make sense. So it's just finding a balance. Nothing is absolute, and taxes always change. I tell clients, expect every 5 to 10 years, there's probably going to be either a big estate or tax law change. And that's what I'm here to keep up for you, is because you don't want to read through tax law or, go through what the changes are. That's my job, is to filter through that information. How does it actually apply to you?
Definitely. And you got it you hit it right on the head. I mean, everybody's least favorite uncle, I think, is probably Uncle Sam.
Right.
But I know, especially right now, you were just saying the market's kind of been changing so much. And I guess that's a good question, with how dynamic everything has been. And I get that, each client's different, and some of them are way more conservative. Some of them are going to be super risky. So, a lot of the riskier people are probably really excited right now because the market is a little bit in turmoil. But for some of your more conservative clients, I mean, have you had to, maybe plan their retirement a little bit more strategically? What strategies are you currently using, if any, to really help them preserve or to ensure that their retirement is sort of set up in a way that's going to be most beneficial for them?
Sure. So for people that are in that distribution phase where, and that's a big mindset shift, I don't want to gloss over that, where you've spent a lifetime saving and accumulating and growing this wealth, and now it's time to spend it down. That's already a big shift to try and get definitely ahead of. And like you said, there's always going to be some anxiety, right? Ultimately, I say I help people with 3 things. The first is, are you actually on track to where you want to go? Or in other words, am I going to be okay? Is what people want, right? That's what they're looking for. Am I going to be okay? 2008 is still very fresh in people's minds, and given recent events, it's coming up again.
Yeah, right.
So, funny how history just kind of rhymes and repeats itself.
Yeah.
So that's the first question. Second question is, how can we improve your investments? How can we be mindful of taxes and fees and reduce those as much as possible where it makes sense? And then the third one is how can we reduce that lifetime tax bill? Again, I specify on lifetime tax bill. We're not specifying on, hey, how do we reduce your taxes as much as possible in a single year? Because again, if you defer everything, that can create a ticking tax time bomb for you down the road. And that's what we don't want. But to answer your question of how do we deal with struggles in the market and fears, because there always are, I'm a big fan of using guardrails when it comes to pulling income. because, you know, you may have heard of like, oh, there's the 4% rule, and now it's the 2% rule. And for those of you who aren't familiar, there's some research done, I think back in the 90s, or it was a while ago, where I think Bill Bengen did a lot of retirement research and said, okay, 4% of you can withdraw 4% of your portfolio if you just have liquid investments. And that is like the minimum safe withdrawal rate, right? Because going back to, I think 1969 was the worst time to retire.
Yeah.
Which is not 2008, right? 2008 was actually not the worst. 69 was, because we had inflation, we had multiple rolling bear markets throughout the 70s. So that's a very static rule, though. However, that's the thing. It's great for research, and it's valuable to research and see what's happened. But most people don't just say, okay, if this is you, if you say this is the amount of money I'm going to take, I'm going to increase it by inflation every year, and I'm never going to change anything. Then I guess, yeah, use 4% rule.
Yeah.
The guardrails is a little bit more updated research. If people want to nerd out, it's from Guyton and Klinger. I think they did some really good research around it. But basically, it's a more dynamic approach to how people actually live their lives, right? So we can start with probably a little bit higher withdrawal rate, and with the understanding that there's going to be some rules in place. Just like driving down a canyon road, there are guardrails there for a reason, right? If we start drifting too far to one side, like for example, if the portfolio is doing really well and we're getting close to our upper guardrail, and if we go over that guardrail, then great, you get a pay bump. Basically, hey, here's a bonus. The investments are doing really well, and you can afford to increase your income a little bit. Okay. Now that the most important thing is to realize that works on the other side.
Yeah.
Okay? If we start drifting to the other end, like last year, or, you know, a big market event, markets are down, we're going to do things a little bit differently. Okay. We are going to take a little bit of a haircut. Okay. It's not like we're cutting income in half or anything, but which is what people do naturally anyway. Right. I mean, in 2008, you see recession everywhere on the news, and people just naturally don't go on as many vacations, or, you know, buy the big fancy trucks or whatever, right? They naturally cut back anyway. So it just kind of fits human nature anyway. So that's what we use to in place, is there's very clear, hey, here's our guardrails, here's our plan for what we will do if we trip one of these guardrails. So, you know, if we've already talked about this and we already have set rules in place, we're just following the plan at this point. So it's not reactive, right? I mean, yes, we're reacting to the balance, but we already have set steps in place. So that helps. I like that approach. It's really easy for clients to understand. And again, it's kind of what they do already.
Yeah.
Yeah.
And really, what's and maybe you probably have a lot of conversations with your clients when these types of things are happening. What's something that maybe is too common of a conversation, or something that people just don't look out for enough, that you tend to have far too often, that you kind of just wish more people knew about, or maybe it's just something you wish more people knew about in general?
That's a tough question.
Yeah, it's loaded. It's definitely a loaded one.
So many things. You know, can you repeat the question? Sorry.
Sure.
I'm
So
gonna need a minute.
really, just to simplify it, it's more of just, what's a common conversation you have a lot that, you know, you wish more people knew about? And, you know, maybe it's something as simple as, hey, what's the difference between different IRAs, or my tax liability at a certain point, or, you know, what's maybe going to be the safer side of things for an investment, or a more risky investment? What's maybe a conversation you have with clients who they're just saying, hey, here's my money, I want, you know, this much out of it, and I need you to do this for me, and maybe they're just kind of missing a point or two.
Okay. Yeah, I'll hit on a couple things.
Sure.
First one that I see a lot, to be honest, it's people that use advisors. Is just because you have 20 different mutual funds in your account doesn't mean that you're diversified. Okay. And what I mean by that is once you take a look under the hood, you see that a lot of these funds own the same companies. So that's a problem because, you know, a fund has its own trading expenses and stuff that it needs to do to keep its lights on, which is just cost of doing business, right? And trades have costs for the big firms. And when you're paying 20 different people to buy and sell Apple and Microsoft for you, that creates a lot of drag, both from a tax perspective and just from a returns perspective. So that's real easy, low hanging fruit. Hey, let's make sure the investments make sense for you. Actually line up what they're wanting to do. Yeah, that's one I see a lot. The second one is I hear people say, "Oh, I don't want to pay any taxes." Well, I understand. I'm on your side here, guys. That's just not the world we live in, unfortunately.
Sadly.
So we, you know, there are very few situations where you can completely eliminate taxes. For business owners out there, if you know Section 1202 stock is a really good opportunity to eliminate capital gains, but there are a lot of qualifications that need to happen, and most people don't meet those qualifications. The two big ones, for example, are you can't be a service-related business. So, like me, I run a financial advisory practice. That's a service-related business. I'm disqualified. So that's the first thing that people usually get disqualified from. The second thing is you have to be a C corporation. Okay, and you have to own it for at least 5 years. So if you're an LLC or an S corp, which most small businesses are, unless you want to work with a tax attorney, make sure it makes sense, you know, convert to a C corp and then wait 5 years and then sell. Most people don't want to do that though, right? If they're talking about selling, they want to sell now or within the next 12 months. So those are big ones. Is just managing expectations of, yeah, taxes will happen, but again, it's people feel like taxes happen to them. It's a very reactive thing. The only time they look at taxes is when they work with their tax preparer and they say, okay, here's either your refund or here's your bill, and they don't know why. You know, and they don't need to understand all the working parts, but it's something that I really try to stress and work on with my clients is, hey, these are the big pieces that will affect your taxes, right? Your income and your deductions and all that stuff. And just setting expectations. So that helps a lot of, you know, taxes will be paid, but now we can be more proactive and choose when and how we're going to pay Uncle Sam, you know, as little of a cut as possible, right? I mean, you don't get extra patriot points for overpaying on taxes, right? It doesn't make you any more patriotic than your neighbor. I've heard some people say, which is a great saying. I love it. So just really what it comes down to is managing expectations. Another one is all the professionals in their life aren't communicating. So you have, you know, maybe you work with an estate attorney, maybe you have a tax preparer, CPA, and maybe you have a advisor or a real estate broker you work with a lot. They all kind of work on their own silos, and it's really not to the client's benefit, right? Everyone is trying to help the client, but everyone has their own ideas and they may be pulling in different directions. So especially between the tax preparer and the advisor, there absolutely needs to be an open line of communication there, right? There's no, you know, and you have to be careful about it because they have their ideas and their experiences, and you may be missing something. So, you know, there's something that you can learn from everybody. And that's the approach I try and take is, hey, you know, these are some of the ideas I have. If I go to a tax preparer, for example, what am I missing? You know, what do you see on your end? And really just collaborate and work together. Again, you're both working for the client, right? That they're the ones paying you. So make sure that it's a good experience for them.
Definitely. So. Okay. Yeah, no, that's all perfect. And Marcus, I also do, before we wrap up, I want to give you maybe an opportunity to give yourself a little bit of a shout out. So what might be sort of the best way for people who are interested in maybe learning more, who might want to work with you, really just to reach out to you. And of course, in the newsletter also down below, I'm going to link your LinkedIn profile and your website. But if you want them to reach out to you, is there any better way?
Yeah, I'm on LinkedIn way too much. So I mean that LinkedIn works. You're happy to go to the website as well, which is www.focalpointplanning.com. And that has, my phone number and email and little contact form there. So that's probably the best way. You can kind of poke around the website, see kind of how I think, see again who I work with, because we want to make sure that you find an expert for your situation.
Definitely. Well, okay, awesome. And Marcus, I really appreciate you sharing some knowledge with me today. I learned a lot from you, and of course, I think everybody else did as well. So I appreciate your time, and thanks for joining in.
Absolutely. Thanks for having me, Paul.
Of
See
course.
ya.